So Thursday.
Thursday.
Natural gas, right?
That is correct. So let's jump over. I'm going to jump over to the NADEX platform. So we get our natural gas numbers. Thursday, 10:30 a.m. Eastern time. We get the EIA inventory numbers. Yesterday, quite a number for oil, right? In terms of, I believe the draw was like 9.9 million barrels. Right. Estimate was 3 million. Of course, oil nearing $73. Natural gas, some volatility as well, though. I mean, just pulling back the chart just since this morning, since almost 8 a.m.
It's over $3.
Yeah, we've gone from 297 up to 301. So it'll be interesting to see how these line up. We're going to jump into the 11 a.m.s first. Now, what's going to be kind of tough here is that we've gotten some volatility already in terms of these may not line up perfectly well, looking for option trades on both sides of the market, because as you can see for the 11 a.m.s, your only option if you wanted to buy both of them would be using $3. Now, not the end of the world. We're at 301. Yeah. What we're going to see is even 301 too, because this ticks in tenths of a penny. That's about $12 of intrinsic value that this contract has. So let's put this in. So market's trading at 301.2. We're getting in at 301.9. So we're paying $12 of essentially intrinsic value. We're paying the remaining $7 in premium. So the bullish spread in this trade would cost us about $19. If you wanted some exposure to the negative side as well, you could be selling the spread that starts in the similar area. And as you can see, this is the same exact premium, but no intrinsic value. Right. So you're paying $7 in premium for both of them. That's pretty cool how that works. It is. It helps you understand the pricing of this, you know, where, okay, that makes sense. Now we're paying, you know, as this ticks up, you're looking at about 13 ticks of intrinsic value to the upside, vice versa, you know, no intrinsic to the downside. So that trade cost you about $26, which represents 2.6 pennies of movement away from $3.
And that's the 11 o'clocks.
And that would expire at 11 o'clock. So let's jump to the noons. Close these out. Now, they're going to have the exact same prices. Now, when I say it's like kind of unfortunate we moved, because if natural gas was trading right at $3, you might be able to get a trade where you're just paying premium of maybe 9 or 10 bucks on each side, so you're costing you $20 as opposed to 26. And percentage-wise, that turns into big numbers when you're talking about, you know, I mean, because what is that? That's 30% extra money you're putting up for 26 versus 20. And you start doing those percentages, they add up.
It's good when you do it that way, because 6 pennies doesn't seem like it's 30%.
No, but it is. And it's not, just to put it, it's not 6 pennies, it's 6/10 of a penny in the price of natural gas, and it's $6 in your contract, but percentage-wise, it is, because, you know, that's where it's so nice when you're able to get in for, you know, 2 pennies. Well, geez, then all you need is 2 pennies of movement versus needing 2.6, 3 pennies. So here's the 12 o'clocks, same exact spreads, so only the difference here is that you're going to be looking at an extra hour. So the bullish trade is going to cost us about $20. Pretty similar. You have about 12 cents of intrinsic value, $12, which is like 1.2 pennies of intrinsic value, and the rest being premium. And on the vice versa side, it's probably going to be exactly similar. And as it is, that'd be costing us about $8. So here's a great example that not much money for that extra hour, right?
No, it's not.
Like nothing almost. I mean, it's, you know, you're talking about $2, which is 2/10 of a penny that you're paying in the market of natural gas for that extra hour. In my opinion, that's worth it. You know, if you're looking for volatility, which you should be if you're making this trade, that seems like a pretty affordable price for the extra hour to have that, you know, exposure. Yeah, for sure. Now, let's see how the 230s line up. So this is nice.
They're going to line up too.
They are. And I'm just going to jump right to the dailies, because these are 50 cents. Yeah. And just the reason why, and I'll pull them both up, is because they're usually identically priced as they exactly are. So here's a great example. Here's your 50-cent spread. Here's your 40-cent spread. Exact same bid offer. Yep. If you're going to be buying this, why would you ever be capping yourself out for 0 extra? So that's why, you know, normally, and the reason why the market isn't charging you is because realistically, there's almost a 0% chance. But like we say, it's not zero. So if they're not going to charge you for it, why not have that probability on your side? So we'll go to the 50 cent, and let me close this out, jumping back to the full dailies. Here's our bullish spread. Whoops. There's going to be our bearish spread. So you got 50 cents of exposure to the upside, to the downside. Yeah. Same thing. We're going to have our intrinsic value of about $11. So this costs us 28. This costs us 17. Again, what's perfect here is, see the difference, $11? Yes. There's your intrinsic value. The rest is premium. So you're looking at $45. But the key there is that you have exposure till 2:30. And you have exposure all the way to 50 cents. So we'll see what happens. 10:27, we get those numbers. In 3 minutes, we'll find out what
Come
happens.
right back.
Totally.
Stay right there, folks. You have the Dow right now down 19. NADEX up 2. S&P's off 2.5. We'll come right back. Welcome back, folks. Natural gas inventories. Let's see. We got a build of 66 BCF.
66 billion cubic feet. Median estimate was 72. Pretty close in line. Shouldn't be anything too dramatic, but let's find out. We'll jump back over. Whoa, look at that bar, man. What happened there? Look at that spike. So you talk about quick fingers, man.
Wow.
Yeah, I mean, not too big of a miss, and we'll go back to those numbers and break down a little bit more about what they talk about. But we're trading at about 3.012, right?
Yeah.
About 1.2 pennies above 3. 3 would have been our pivot point that we were using. All of these trades would have had a little bit of a bullish bias today because you start with the intrinsic value to the bullish side.
Yeah.
Not the kind of action you would want if you were trading these, because 3 on the dot becomes your max loss. And geez, we're within 7/10,000th of a penny, of a dollar right now of that number. But the good thing is it's 10:31.
Yeah.
Would have until 11
You
or
got
12
time.
or 2:30, depending on
Right.
what we chose. And you always like to see some big spikes one way or the other, as opposed to just kind of fizzling
Oh,
out
yeah.
into the news.
Big time.
So a little bit of reaction, down about a penny from those numbers. And let's jump back to that. Let me find the right screen that we're on. Is it that one? No, we're jumping around. I think it might be that one. There we go. Yeah, so the East had a rise of 24 to 430 being the inventory. Midwest had a rise as well. Every area actually had a rise. 24, 6, 5, and 7. Inventories are at about 501 billion cubic feet, below the 5-year average. Yeah, so it looks like the range was anywhere from 66 to 77, and it comes in at 66. I mean,
Yeah.
nothing too dramatic, not exactly what you'd be looking for if you were trading the volatility. I mean, what you want is a huge surprise, obviously. Something like we got
Look
yesterday
at
in
the,
oil,
it
right?
looks like it's getting a little more...
Yeah, we're right at that $3.
Yeah.
I mean, it is, you know, again, we're only 2 minutes afterwards. It's quite a bar. And, geez, we've had some volatility like we talked about from this morning. We're
Look
at
at that.
297 not long ago. And, yeah, anywhere, depending on what you were trading there, you needed 1 penny, like 2.5 pennies.
2.5, 2.6,
Yeah,
right.
somewhere around there for the 11s or the noons. So we'll check back in. We'll see if that natural gas market reacts.